Hey everybody, let's chat about something. How do we front load a whole life insurance policy specifically designed for infinite banking? Why would we do something like that? What are the benefits of doing something like that? We're going to cover all that in today's video, so let's hop into it. So a couple things. What does front loading even mean? It means exactly what it sounds like. You're dumping a semi-large to huge amount of cash into a whole life insurance policy. Who would do this? So maybe you're an investor, maybe say like a real estate investor or any kind of investor really. You've got a huge, a large sum of cash that you have just sitting around. It's not really doing anything productive. And or maybe you're somebody that's got a huge amount of money saved in, say, like a savings account, whether it be high yield or like a traditional savings account. And it's just not really, number one, if you've got money in the bank, like it's not really protected. Yes, you've got FDIC and all that, but FDIC will only insure you up to, to 500,000 if we're being generous. So, if it's in a bank, we've been hearing a lot about these, bank insolvency issues. So bottom line is maybe you're looking for a safe place to put it. Insurance companies have, stood the test of time, especially the ones that are mutual companies and pay dividends. They've paid dividends for, going all the way back to like the Great Depression, through 2008. Like insurance companies are some of the safest companies you could put money into and open a policy with. So maybe you're somebody like that. Maybe you're somebody that meets both of those criteria, or maybe you just want to put money into a safe asset to where maybe you don't get the best returns, but you're not really looking for returns. You're just looking for safe, consistent, constant growth, and or maybe you're not looking to pay taxes on something that grows. A whole life insurance policy could be, if you're somebody like that, you might want to look into opening something up, whether it's through me or whoever you speak with, but you may just want to look at it. Maybe that's why you're watching this video. But let's run through a couple examples of what a front load could look like. Again, these are just examples. So keep that in mind as we're going through these, and let's just get into the first example. All right, so let's take a look at this. This is actually an exact example that I just helped a client with. He wanted to dump in $120,000. He just had it basically sitting in a bank account. He didn't really feel like it was safe, and he also wanted to put that into something that's also going to grow, but that he can also leverage to put into a different investment that also cash flows. So say something like private equity investment, for example, like in something into a cash flowing business. He also had a really specific criteria that he wanted as much of the cash flow from that investment to pay for these out-of-pocket premiums as much as possible. But he's also going through a divorce. So, he didn't necessarily want to pay premiums forever, which is fine. He's a little bit older. He's 55. So for this specific example, we decided to shut off premiums after year 7. So let's take a look at some of these numbers here. So first year, he dumped in $120,000. You can see immediately with this company's current dividend scale, he's got access to almost $110,000 of it, which if you're doing math here, that's 92% liquidity instantly as soon as he puts this money in. Like that's pretty crazy for whether you're new to this channel or not. If you're somebody that's putting in like a 401k, putting money into 401k or an IRA, like you can access that money until you turn 60 years old. So if you're somebody that's been investing since they were, 20, 18, somewhere in there, like that's a long time you don't have access to your capital. With this, you have access to this right away. I wouldn't recommend leveraging 100% of it right out of the gate. I like to put some buffer in there for everybody that I help. But to have 92% of your cash available to do whatever with, like that's unheard of. And then every year after that, we dump in another $12,000 each year. So you can see he dumps in another $12,000. The increase in the cash value just from the dividends is almost the amount of premium that he paid in. The other cool thing about this is that say his investment doesn't work out for whatever reason, he can't rely on that cash flow. The monthly minimum that he can contribute to this policy and still keep it in force is $600. So if you're keeping score here, $12,000 is $1,000 a month. Now, if he for some reason can't pay that, he's got a $400 buffer there. He just has to pay $600 to keep it in force. He still has access to this cash value. Obviously, it's not going to grow as much as it would if he's paying $1,000 a month, but still, I mean, it's a safe asset that you can put money into. And all of this increase in cash value right here, 10, 13, 13, another 14, 15, like none of that is being taxed. He can leverage this cash value whenever he wants, and he doesn't have to pay taxes on it. I'm going to selfishly pitch whole life here. I'm not going to pitch me, but if you're looking for something like that, like if you get a proper agent that knows what they're doing and knows how to structure these and knows what companies to work with, like there's no other vehicle like this where you can get all these perks and these benefits with your cash. The other thing I did want to mention here, if you've noticed, this does have a 7-year term rider on it. Basically, the term rider just exists so this policy doesn't turn into a modified endowment contract. The reason that you can't do that is because your cash value has to be within a certain percentage or outside of a certain percentage of the actual death benefit. If the cash value gets too close to the death benefit, then it turns into a modified endowment contract. So the term rider basically just increases the death benefit temporarily. And after year 7 of this particular policy, you can see it falls off here quite a bit. So we have a $1.4 million death benefit. And then in year 8, it drops off to $246 at minimum. But with this company's current dividend scale, it's $303 death benefit. But he still has access to all this cash value, and this is not going to turn into a MEC. If you don't know what a MEC is, or a modified endowment contract, it basically negates all of the tax advantages that come with a properly structured whole life insurance policy. So anytime, if you do have a modified endowment contract and you want to use this cash value, you're going to get taxed on it. So that's why we generally speaking, want to avoid a modified endowment contract. And this, as written, is not one. Another thing to keep in mind here, if you remember, I said that this particular client didn't want to have to pay premiums after year 7, so we shut those off. Generally, I wouldn't recommend that, just because we want to pay as much premium as long as possible, so that way we can make this as efficient as possible and increase our cash value. For his particular situation, it made sense, but for your situation, it may not. So that's why you want to have a conversation with an agent that knows how to structure these. So same exact situation here, $120,000 dump in, $12,000 every year thereafter. If you'll notice, the initial cash value is a little bit less. That's just because of the particular premium structure for this. And however, we're still getting really solid increases in cash value. But as you can see here, by the end of year 15, he's got $300,000 of essentially dry powder that he can do whatever he wants with. So he's been paying these premiums for 14 years, whereas over here at the end of year 15, he's got $30,000 less in cash value to work with. So hopefully that shows you the power of paying as much premium for as long as possible as you can. But keep in mind, if you open up a policy and you can only pay premiums if you open a policy like this and you can only pay premiums for 7 years, that doesn't mean you can't open another one. A lot of people, when it comes to infinite banking specifically, have an entire ecosystem of policies. So just because, say you open one like this on yourself, that doesn't mean that you can't open another one, say like on your son, on your daughter, on your spouse, on your niece, on your nephew. Like you can have a whole system of these. And because you're the policy owner, you can still dictate how that cash value gets used. Now, because we are talking about a 55-year-old, this cash value might not look that impressive, but if you're talking about doing a dump in for, say, somebody who's like my age, at say age 35, these numbers look a lot more favorable. So let me show you that real fast. All right, so we're looking at somebody who's my age. I'm 35. So let's say I put in 120,000 in here. I have 110 immediate access to what I put in. So let's do some math on that. If I can type, good Lord. 92% right off the bat. Again, I can't think of another vehicle that offers that type of access to your capital without taxes. But I could harp on that all day. All right, so just for the sake of example, same scenario, 35-year-old putting $120,000 at first. Immediately they have access to, call it 110. If you're keeping score, that's still 92%, pretty close. And then this person is putting in $30,000 a year. So $30,000 a year is $2,500 a month. If same scenario, there is some flexibility built into this. If you can't pay the $2,500, I mean, you're gonna get basically your whole year of premium just increase in cash value. So if you can't pay it, you can always use your cash value to pay those premiums if you needed to. But if you're still able to pay some out of pocket, the minimum for this is $750. So, same thing as the first example, there's a lot of built-in flexibility with this. So again, I'm going to reiterate, that's why it's so important for you to find an agent that knows how these work, knows how to structure these, so that way you're not getting somebody that's just looking out for their pocket. Because if you structure this improperly, number one, you're not going to, typically with whole life, like say you were to dump in $120,000 into a traditionally designed whole life, you're not going to see any cash value year one, probably not any for year two, and then you'll have like a measly amount in year three. When those policies are designed that way, that's like max commission for the agent to set them up that way. With this particular policy, the commission can be cut anywhere from 40 to 90%, depending on how it's structured. Okay, now there are some certain IRS guidelines we have to work within in order to make sure this doesn't turn into a modified endowment contract. But just so you know, like the agents that know what they're doing, they're not getting as much commission as somebody who's trying to scam you. So take that for what it's worth. So if we put in more premiums, you can see like from the first example, he only paid for 7 years and we have access to $194,000. Well, hopefully you can see the power of being able to pay as much premium for as long as you can. By the end of year 7, I mean, you got almost double the amount of cash value. That's because, again, I'll say it till I'm blue in the face, the way this particular policy is written, you can put in as much premium for as long as possible. Now, that's ideally what you want to do. And then if in this scenario, by the time this person turns 56, they have over $1 million of dry powder and they have all of this money that they can do whatever they want with in between now and then. Now, this person doesn't stop paying premiums essentially until they turn 65. And by the time that happens, they have over $1.8 million. So hopefully that at least gives you some idea of what it's like to front load a policy for the infinite banking concept. Hopefully you're able to, wrap your mind around what it could look like for you. Obviously there are some guidelines we have to stay within. So like, for example, you could be, somebody that makes $25,000 a year. Maybe you have $2 million saved in the bank. You're really good with finances. Well, your income is going to dictate how much, number one, you can actually contribute monthly outside of your, initial dump in. But also number two, the insurance company has to be okay with issuing a semi-high death benefit type policy for somebody that doesn't make a lot of money. Unfortunately, I don't necessarily agree with it, but that is how these insurance companies work. You have to understand that insurance companies are in the risk mitigation business, so they're trying to mitigate their risk as much as possible, while still giving you access to your capital and how this policy should be designed. But they also need to look out for their bottom line as well. It just kind of is what it is. Selfishly, I'll put in a plug for myself. If this is something that you're interested in doing, drop a comment, send me an email, schedule a call with me, and we can take a look at what something like this might look like for you and your situation. Every situation is different, so there is a lot of customizing and tailoring that needs to be done. But it doesn't have to be with me. Just make sure you find somebody that, like I said earlier, knows what they're doing. So I hope you found this helpful. See ya.